Hey guys, welcome back to the Shipmate YouTube channel. This week we're talking about inventory accounting methods. So guys, whenever you're talking about accounting, there's really two things you're talking about, and that is LIFO versus FIFO. There's also an average method, which we're not going to talk about because no one really uses it. But we're going to explain what is LIFO and what is FIFO and when you can use them and what the advantages of both are. FIFO stands for first in, first out. This means that the first piece of inventory you receive in is the first piece of inventory you sell. LIFO is last in, first out. This means that the last piece of inventory you receive in is the first piece of inventory you sell. This is really important because a lot of times you're receiving shipments of inventory all the time, right? You might have 3, 4, 5 batches of inventory or, production runs coming into your building or your facility every month. So you might pay different amounts for these things over time. The first time you buy it, it might be $1. Second time it might be $1.50. Then, the price goes up and then all of a sudden it's $2. So you might have a lot of different costs occurred for your inventory over time. And it's important to know how to match up your costs with your sales. So that way you know how much profit you made and how much money in inventory you have. So guys, what I wanted to do today is really walk through a very simple example, right? So imagine we're at Bill's Furniture Company, right? And Bill makes, 10 tables every week, right? We make 10 dining room tables every week, so there's wood, there's nails, there's glue, there's all these costs. And, the first week we're operating, we make 10 tables and they cost us $5 a piece in materials and labor. All of a sudden, the next week, the price of wood goes up, right? So during week 2, the cost of our tables go up to $10 in materials and labor. So all of a sudden, those same 10 tables cost twice as much. And then all of a sudden, the third week, not only does the price of materials go up, but, our table builder asks for a raise. So now we're paying $20 a table to make those same 10 tables, right? So it doubles again. So we have week 1, our tables cost $5 to make. Week 2, our tables cost $10 to make, and week 3, they cost $20 to make. So you see really quickly, these different pieces of our total inventory cost different amounts of money to make and acquire. So for the ease of simplification, let's say we sell 15 tables all at once. The question then comes, which tables did we sell? Did we sell the tables that are cheap to make or the tables that are expensive to make? And this is where LIFO, FIFO really comes in. If we're going with FIFO, that means that we sold 10 $5 tables, right? And 5 $10 tables. That means it costs us $100 to make the 15 tables we sold. If we sell each table for $30, that means that we get $450 for the tables when we sell them, and they cost us $100 to make. So we make a profit of $350. This also means that the value of our remaining inventory, the last 15 pieces we have, is $250, right? So you can see by using FIFO, we make a lot of money and we have a lot of money left in inventory. But if we use LIFO, right, we're actually selling them the 15 most expensive tables we made. So we're selling them 10 $20 tables and 5 $10 tables. So that means this inventory costs us $250. So when we get that same $450, we only record a profit of $200. And the inventory we have remaining is worth significantly less because it's those early units that we didn't pay much to make. So we only have $100 in inventory remaining. So you can see how these two scenarios have you come out with different amounts of money made and different amounts of remaining inventory. So this is where it comes into the whole accounting piece. So most businesses operate under FIFO. FIFO is, the main way people do things. It's the international standard, and that's generally what businesses do to keep accounting because with a lot of things, you're going to want to be selling your earlier units rather than your later units. And it's really a true estimate. And that's how things are done most of the world. In the US, LIFO becomes slightly more popular, and that's because it can be a tax minimization trick. So as you see, we made less money, but our inventory value is smaller. So since we made less money, we're going to pay less in taxes on, a $200 profit than we would have on the FIFO $350 profit. So you see this a lot of times with US industries where they'll use a LIFO strategy on that balance sheet. So that way they might have less inventory being held value-wise, but they're able to claim they made less money on their taxes, and that allows them to pay less. So if you're going to be a company that's having long-standing inventory and you're constantly going to want to be selling those inflated, newest pieces of production because costs rise over time. So if you can benefit from that, that's something you may want to talk to an accountant about. I highly recommend talking to an accountant before using either of these methods, but it's important to illustrate, the differences between these two and how they can potentially help you in your business, because there's benefits and drawbacks to both. So guys, I hope you understand LIFO versus FIFO a little more and kind of how that accounting works when you're dealing with both your inventory numbers as well as your profitability. Thank you guys so much for watching this video. If you could do us a favor, give us a like, give us a share, give us a subscribe. We could really use it. We're trying to get to 10,000 subscribers by the end of the year, and we think we can do it, but we need your help. Thank you so much for watching, and we'll see you next week.